Every year, millions of Americans commit their savings to the stock market. Yet, for many, those accounts eventually show more losses than gains. Most beginners start at the surface layer. They see the market as a stream of digital numbers, flashing red and green across a smartphone screen. While the interface is modern, the institution itself is a physical marketplace built on a century-old foundation. Treating a centuries-old financial system like a digital casino shifts an investor's focus away from the underlying mechanics, often leading to decisions that carry a high price. Take Mike, a 27-year-old from Miami. He discovers a company trending online, where social media posts are filled with screenshots of massive overnight profits. Mike buys in at the height of the excitement. When the momentum shifts and the price begins to slip, the excitement turns to panic, and he sells his position at a loss. This strategy relies on social media hype and human emotion, leaving the actual health of the business out of the equation entirely. Approaching stock tickers like lottery tickets creates a high probability of becoming a victim of one's own psychology. Understanding the market requires looking past the screen. Consider Jake, an investor from Austin, Texas, who prepares to invest $5,000. Executing a trade gives Jake legal fractional ownership of a functioning American business. This ownership interest represents a claim on real-world assets, physical factories, distribution networks, and employee labor. These physical operations produce a specific output, cash flow. As the company sells products, that revenue supports the value of Jake's shares. The daily price seen on an app is a public auction, reflecting the immediate tension between buyers and sellers at any given minute. While the auction is loud and constant, the long-term trajectory of a stock is determined by the performance of the business beneath the ticker. Professional investors often operate on a different timeline. Sarah, a marketing manager in Chicago, approaches the market with a multi-year horizon. She looks past the high-frequency chaos of the trading floor, ignoring the noise and the excessive leverage that drive short-term price swings. Sarah focuses on business fundamentals, revenue growth, profit margins, and the quality of the management team running the operation. Investing in a titan like Coca-Cola means owning a piece of a global logistics operation that moves millions of physical products to customers every day. Even the largest technology firms like Microsoft began as small enterprises. Early investors succeeded by recognizing the fundamental potential of the business model to scale and generate profit over the long term. While amateurs focus on guessing the next short-term move, professionals focus on identifying high-quality businesses to hold for years. Long-term holding introduces the cumulative effect of time. We can see this through a final hypothetical investor, Emily. This chart shows how compound growth works. Returns earned on an initial investment eventually begin to generate their own returns, creating an accelerating curve. This mathematics requires patience. The exponential effect only takes hold if an investor maintains their position through years of market volatility. Time spent in the market consistently proves more effective for the everyday investor than trying to predict the exact moment to enter or exit. Whether an investor is looking at the short term or the long term, no strategy succeeds every single time. Survival in the market depends on risk management. This involves controlling position sizes and maintaining emotional discipline to protect capital when the market moves against you. Durable success rests on 3 principles: understanding exactly what you own, controlling your risk, and prioritizing long-term growth over quick profits. The stock market is a marketplace where businesses, risk, and human psychology collide. Whether you are managing your first $100 or a 6-figure portfolio, the most significant advantage is a clear grasp of the mechanics beneath the surface.